Inflation is beaten. Everything is good. Party, 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 all across financial markets. But wait, is really everything okay after 1 month's inflation numbers? Or is there something hiding under the surface here that maybe the markets are overlooking in their boundless enthusiasm? Welcome to Macro Money. This is Ilya Spivak, head of global macro here at tastylive. And we're going to have a look here not only at what the markets have been doing the past 2 days, which has been incredibly emphatic, but how it might survive or perhaps take a bit of a pause when met with economic data. So the question that we are going to be asking ourselves here today, looking at everything that's going on and everything that's coming up next, is should the markets be cheering? They certainly are. But the question is inflation coming down for good reasons? Are the implications for the Fed good implications for risk sentiment? Or are investors getting happy about the wrong thing? Now, we'll begin with a bit of stage setting. What you see here is the S&P 500 in the blue. You see the 12-month Fed policy outlook in the orange. So what that's telling you is where Fed funds rate is expected to be 12 months from now, as it is implied in rates futures. So this is market pricing, not any economist's expectations, not any sort of analyst's forecasts. This is the collective wisdom of the market. And what's been going on the past several days is absolutely unmistakable. We see here the phases in this rates outlook and how it's evolved. Here is the beginning of this year. That's the U.S. economy looking strong and stocks not liking it because we think at this stage that the Fed is going to hurt growth and attempt to really dial up rate hikes and hurt earnings and hurt economic activity. Then, of course, the SVB-led banking crisis happens and rate hike expectations collapse. We then go on a long period of recalibration. First, we digest the banking crisis and its move somewhat into the background. Then we digest the debt ceiling debacle. You can see as that happens, stocks begin to kind of inch up a bit. Then, sometime at the beginning of May, the markets decide that these things are not a big concern, that the Fed is not going to be held back from fighting inflation, and policy expectations begin to turn more hawkish. We've gone back into an inverted relationship here now, much as we did here. Only this time, instead of the policy outlook going higher and stocks not liking it, it's the other way around. The policy outlook is going down and stocks do like it. Ostensibly because the hurdle rate on investment that is implied by rising rates is just about done going higher. And the hope seems to be, clearly, looking at what stocks are doing here, is that this will unleash the animal spirits, that this will remove a burden from economic activity, be good for consumption, be good for job creation, be good then for growth, and in that, be good for corporate earnings. Ostensibly, this is why stocks are going higher. If we look at the way the yield curve has evolved, we can see it has flattened significantly from the 6-month point and further out. as relative to where it was even just a week ago. In fact, it's even a little bit flatter from the 6-month point than it was in the aftermath of the last Fed policy announcement. So the Fed pauses after 10 consecutive hikes, and the curve is flatter now, despite the fact that since that time, Jerome Powell spent nearly a month attempting to find every microphone he could get his hands on to say a bunch of hawkish things into. He did it in Congress twice. He then went to the ECB forum in Portugal and did it again. There was, of course, the press conference after the policy announcement itself, where he tried to sound as hawkish as he possibly could. And yet the market is looking at this and saying, well, looks like they're about done here. And none of that has really dissuaded them from looking at another rate hike in the near term. But that clearly is no longer a source of concern. We can see here the front part of the curve from the current rate out to 6 months is, in fact, a little bit steeper. We are, in fact, looking at a little bit more tightening in the near term. The market's just not worried about it. Instead, it's excited about the more accommodative posture thereafter. And it's a positive story, seemingly, on inflation expectations, too. Of course, all of this optimism substantially powered by inflation numbers that we've seen come out just earlier this week, and arguably most importantly, CPI came out. It was expected at 3.1%. It ended up registering at 3%, and that's down from 5% just recently and 4% at the most recent reading. So this is quite the meaningful decline. If we look at the PPI numbers that came out earlier today, the month-on-month figure actually registered lower than expected at 0.1%. 0.2 is what was expected. The prior number revised down to actually show a decline in May of 0.4%. If we look at what's going on for the year-on-year numbers, they came out weaker also, suggesting that we have a little bit of a better story on pipeline inflation. And so the markets, understandably here, rather happy with what's going on. The year-on-year number out at 0.1% on PPI against expectations of 0.4. The core PPI down to 2.4 against expectations of 2.6. And if we look at what's going on with inflation expectations, this is a familiar chart that we have up here. We can see the 2-year break even, that's the bond market's inflation expectation. That's just the difference between nominal and real bond yields. And when you take that difference, the residual you're left with is the inflation adjustment that you need to take to get from nominal to real. That's at 1.9% now. The 1-year US dollar inflation swap is at 2.2. So what the market is essentially saying is we were at 3% in June. We're going to get to the Fed's target within 2 years' time, and most of that disinflation is going to happen over the next 12 months. That all seems encouraging and seems to suggest that the Fed is on course. And if we look at the current policy outlook, this looks pretty encouraging as well. Notice the July meeting still overwhelmingly expected to see a hike. 89% chance of one still baked in as of today. The slight possibility that that hike comes in September here, but all the way priced in by then. You then get standstill going into next year, and you give away that hike and start to flirt with the possibility of a cut by March. By the time you get to May, a net cut relative to now is already baked in. So if you look at the rates for May, you can already see at that point you're sub 5%. So you're in that 4.75 to 5 range at that point. Whereas now, you are at the 5 to 5.25 range, and after this next hike this month, worst case September, we're in the 5.25 to 5.5 range. So by May of next year, that hike is gone, and a further cut has commenced. You then see cuts at virtually every meeting thereafter. There's a cut in July of next year. There's a cut in September. It looks like there is another cut sometime in between November and December, and probably yet another cut, 88% chance of one, by January of 2025. So the markets are lining up here for a risk rate cut cycle. Now, taking this completely at face value and saying, we've been through a year and some change of aggressive tightening. That tightening has understandably hurt economic growth. We can see global trade volumes turn down. We can see the weakness on the goods side, even just in this latest CPI report. The sum total of global PMI numbers that registered in the past week and a half has now given us the distillation, with a global PMI number showing that taken together, global services and manufacturing sectors actually shrank in June for the first time in months. So it would seem that this is good news, that an important barrier to growth will have turned a corner. But that's only if you take it in isolation. One thing that immediately jumps out as we look at what's going on here is that as the Fed policy outlook starts to get less hawkish here, so too does the break-even rate. So inflation expectations and rate hike expectations are going down together here. Whereas on the entire way up from May until this point, what we've been looking at is inflation expectations holding steady even as the outlook got less dovish, implying essentially higher rates. This should be eye-catching. If the Fed policy outlook is going up, but inflation expectations are not responding, that suggests that the tightening isn't going to get inflation any lower in the minds of investors. What's going on now and seeing these things go down together suggests that the reason why you would see a less hawkish Fed view a year from now is because economic growth is slowing. It isn't because Fed rate hikes are actively pushing inflation expectations to anticipate their impact. Ostensibly, this is the impact. If the Fed policy outlook is getting shallower and inflation expectations are going down, what that suggests is that those inflation expectations aren't anticipating the impact of a hawkish Fed. What they're doing is now responding to whatever weakness in the economy will prompt that Fed to be less hawkish. This decline in inflation expectations seems to speak to a downturn in growth that is ever closer on the horizon and ostensibly may have already begun. That's hardly the kind of good news that seems to be baked into the enthusiasm around stock markets yesterday and today. Now let's look at the Fed's calculus. It has said over and over again that its biggest concern is that service sector inflation is going to be sticky. Okay. The headline number has come down from 4 to 3. Okay, the core number has come in and is now sub 5, registering at 4.8 here in the latest reading. Goods inflation has been squeezed to next to nothing. Food inflation has been squeezed down as we've anticipated. Energy is now a net disinflationary force, and a deepening one at that. But that huge wedge that is services inflation, though it has come in a little bit, is still dramatically higher than where it was, let's call it pre-2021 or even pre-2020. Getting that back down is still a process. We've heard from the Fed over and over again what it would take to bring it back down. And that's not a positive story. Certainly not for risk assets. Consider what is going on here. The driver of inflation in the service sector is overwhelmingly employment. There is, of course, the majority of employment in the service sector. It accounts for close to 80% of all employment in the U.S. economy. And here we have a significant supply-demand imbalance to the tune still of about 5 million workers. Now, we've said repeatedly on Macro Money here before that you don't fix this kind of an imbalance on the supply side, most likely. There doesn't seem to be a grand appetite for massive immigration. And it's not clear that you could even solve this issue with massive immigration because you wouldn't necessarily have the skills that you need at scale. In any case, doesn't look like anybody has the kind of appetite to go and try to solve it this way. There's a lot of conversation about what might happen with AI, but scaling that technology up to address this kind of shortage is not going to happen in a hurry. And so the question then becomes, well, how does the Fed work this down? Add to this that the peak in inflation was June of 2022. So this report that we just got, the weak set of CPI numbers, the weak set of PPI numbers, takes as its base the absolute peak in inflation. When we say that inflation in June of this year grew 3% year on year, what we're doing is we're looking at the percentage change in inflation this month from June a year ago. And June a year ago was the peak of this entire inflationary cycle. In other words, of course we have a low number. We're sitting here a year plus into a Fed rate hike cycle and comparing the results against the absolute peak in inflation that prompted this cycle in the first place. Of course, in relative terms, inflation is going to look relatively low. But of course, as we compare it in coming months, the progress that we're going to see is going to necessarily slow because we'll be comparing against inflation that's already on the way down in July, August, September, and so forth. And so these big jumps in headline CPI are almost certainly behind us. Getting from 3 down to 2 is going to be a hard slog. And doing that is not going to happen without addressing this mismatch in the labor market. Maybe the last CPI report was the beginning of that. It disappointed. Risk pointedly didn't like that. It liked the CPI numbers, but it liked the PPI numbers, needless to say, as well. But none of those numbers dismiss the need for this pain to still occur. And none of it really changes the Fed's calculus on this score. So, with that in mind, the last bit of economic data this week, the very interesting and usually very informative University of Michigan Consumer Confidence Survey. Not often a very market-moving number in terms of its instant impact, but almost always a very telling picture of what's happening in the most important sector of the U.S. economy and by extension of the global economy. Sentiment in what is easily the biggest driver of global demand the world over, U.S. consumption. The expectations here are that we're going to see slight improvement pretty much across the board. We're going to see it in the current conditions index. We're going to see it on the sentiment side. We're going to see it in the expectations component, according to what baseline expectations are suggesting. Not only that, but U.S. economic data, NFP notwithstanding, has generally performed better than expected in recent weeks. So there's perhaps some scope for this consumer confidence number to register even better if, in fact, what this is saying is that analysts' models are unreasonably pessimistic, given an economy that's doing better than those models are suggesting. And so perhaps this, too, is more pessimistic than reality. And these numbers end up looking stronger still. What would be the implications of that? Well, near term, one might say, well, this is the best of all possible worlds. Inflation numbers suggest the Fed can ease back. Meanwhile, the consumer is happy and strong. This is good news. This bodes well for risk. This bodes well for growth. What it doesn't bode well for is this. Even as continued progress just around base effects starts getting harder. And so the question then becomes, well, if the U.S. consumer is happy here, what does that mean for the Fed? If spending is ramped up, what does that mean for service sector inflation? Well, there's upside risk in all of those things if the U.S. consumer goes out there and starts shelling out money because it feels itself relieved of inflation pressures. And that, of course, creates exactly the kind of thing that the Fed is worried about. Might they then rethink exactly what the path forward is? Or will they even have to? Because the message from the Fed has been, there's no cuts coming anytime soon. The fight against inflation is still quite long. We're not looking to end it in the near term. Next week is a blackout period ahead of the next FOMC announcement. And we're going to get some retail sales data. We'll see how that comports with the expectations number. But if the NFP one was telling, and hiring is in fact starting to slow, and the impact of Fed rate hikes is finally 12 to 18 months later, as the Fed suggested, starting to really bite, how optimistic should stock markets be about that? If hiring is slowing and consumer confidence then ends up disappointing, well, that would suggest that as the rubber meets the road and the Fed's efforts are starting to really show up in the real economy, recession risk goes up. That's something that you might surmise, once again, looking at this. That inflation expectations are going down and the Fed outlook is getting less hawkish, but for all the wrong reasons. That pain is ahead. And that's how this is going to get achieved. If, on the other hand, these optimistic expectations hold, we get better consumer confidence. U.S. economic data has been surprising on the upside, so why wouldn't we, after all? Well, then maybe the Fed is catalyzed to be more hawkish. Maybe it delivers the hike this month, and the language it suggests speaks directly to all of this positive thinking in equity markets, which, by the way, is a form of easing, the opposite of what the Fed is looking for, and feels the need to dump some cold water on it. And if that happens, where does that place us in the global business cycle, and how positive can equity investors really feel about that, considering if we look at where the latest round of global PMI data has put us, the global services sector has finally rolled over and has been deteriorating now for 3 months, so much so that the global economy actually shrank in May for the first time in over 2 years. The data out of China has been abysmal. And if there is optimism from the U.S. consumer, the Fed may yet decide that it needs to tighten the screws harder because its main issue, service sector inflation, hasn't really budged to the extent that it would like. And the way to get it there, seemingly, is by hurting the labor market, which hurts consumption, which hurts growth. So we are certainly looking at very emphatic performance here. But as the markets digest, it may turn out that cheering lower inflation numbers misses why they're lower and may need a rethink as we keep seeing evidence emerge of what is to come next. And that is Macro Money for today. It's our last show for the week. We're here Monday through Thursday, right after overtime, with Chris Vecchio, head of Futures and Forex here at tastylive, where he and I try to break down the day's events and what might be happening thereafter. I'm back on with Chris tomorrow for Futures Power Hour, where we'll get a sense of what's going on just a few hours before the weekly close. I'm back on with Tom and Tony for First Call on Sunday. I'm writing for the Tasty Live website in the News and Insights section. Definitely come check that out. I'm also opining on Twitter at Ilya Spivak. Thanks very much for joining, everybody. Good luck trading. See you next week.